Hey guys, JC Parets here of allstarcharts.com, and welcome to the show. Shout out StockCharts TV for having me on. So what we normally like to do here is three things. First of all, let's get a lesson, something we've learned recently, maybe something I learned a long time ago. Definitely get something educational out of this. Let's talk about the market. Obviously, that's what we're here to do. Talk about the market, what's moving, what are we buying, what are we selling, or what do we hope we're successful doing that at, and then we'll take some questions, right? Everybody's wondering, JC, what's up with this rotation, interest rates, SPACs, there's always something to talk about. So we'll dive into some questions there. So, all right. So, really, I'd be hard pressed not to mention the value of monthly candles. I know I probably said this a month ago. Go back and check the tape, but it's true. There's nothing that I know of that forces you to take a step back and identify the direction of the primary trend. There's always, this moving average or this form of resistance or, sector, whatever. There's always other things that can pull us away from recognizing the primary trend, which is what we're trying to do as technicians, is identify those trends. Hello, that's what we're trying to do. And these monthly charts, I promise you guys, I promise you from the bottom of my heart, this is the cheat code. This is the cheat code. You get one data point a month, 12 per year. It might take you half an hour, right? Make a list, email me, I'll send you my list. Make your own list of what matters most to you in your universe for your specific purposes. I probably have a longer list than most of you might have, but that's right. That's my point. Yours can be very simple. Email me. I'll send you my list. Happy to. All good. So monthly charts, stocks, the major indexes, some countries around the world, Japan, Europe are probably pretty important. Interest rates, US 10-year yield, gold, crude oil, right? Maybe some stocks or sectors are more important to you. Focus on those. But the monthly candles, I promise you, take the time, mark them up every month. It's one data point. It's not that much work. It's not that much work. Okay. That's my lesson, monthly charts. And we're going to dive into some monthly charts here so that you can kind of see, because, man, it's so easy to, what the market do today, Janet Yellen and this one and that one. It's impossible. Are you kidding me? Let's identify some trends. All right. So trends, S&P 500 making new all-time highs, monthly closing highs. So Dow Jones Industrial Average, Dow Jones Transports, Russell 2000 Small Caps, New York Stock Exchange Composite, Mid Cap 400, Russell Micro Cap Index, Value Line Geometric Index. The list goes on and on. Europe, Canada, list goes on and on. All-time highs. So what do we know about all-time highs, right? We know it's not a characteristic of a downtrend, right? We know that, so we could check that one off. So it's either we're some kind of consolidation or we're still in an uptrend is sort of where we're at. And then when you look at the alternatives to stocks, things like gold, things like US Treasury bonds, they're all making new lows, which is perfectly normal, right? That's consistent with an environment that stocks are doing well if their alternatives are not, right? That's what makes sense. That makes perfect sense to me. Just a quick look at the advanced decline line, get my mug out of the way. Advanced decline line here. New York Stock Exchange, NASDAQ, down the cap scale, all making new highs. So, again, you don't need me to tell you that. You know that, the Value Line Index. I'm not sure if I brought the Value Line Index with me today, but check the Value Line Index. That's basically the way I look at the median stock, if you will. I always like to compare that to mid caps. That's sort of in my head, in my world. They sort of live together. Value Line, mid cap indexes, equal weighted indexes. They're kind of like in that world together. They're all making new all-time highs. So what that means to me is that if we have stocks, or if you have stocks for that matter, that aren't working, right? So as in general, as investors, if we have stocks that aren't working in this environment, it's because we're in the wrong stocks. Because the median stock is making new all-time highs. The market is healthy. So if we own stock, if there are stocks that just aren't working, that's a problem, right? So we don't want to, what do they say? We don't want to water the weeds and trim the flowers. We want to do the opposite, right? And do more of what's working and less of what's not. So what's working? Well, this is a great bubble chart that shows, So on the y-axis, we have the drawdown last year during the crash last year. So the higher up on the chart, the better it held up during that crash. As you can see here, Amazon, Apple, the Qs, Dow Internet Index, cloud computing, the growth tech stuff. And then down at the bottom, the ones that got hit the worst, airlines, energy, right? All of the sort of consumer spending space and all that. So that's all down here. Now on the x-axis, we're looking at the performance since Labor Day, basically. Since the beginning of September, when that growth versus value rotation really got going. So the further to the right it is, the better it's done since Labor Day. And the further to the left it is, the more it's struggled. So you'll find very interesting, those that held up the best, the technology, the growth, all that stuff, is what's really done the worst since that rotation started, right? I guess that's the definition of rotation. This bubble chart really shows that. This is that rotation. Look at regional banks. I mean, are you kidding me? Regional banks have been the best performers. Industrial and metals, copper mining, right? Even the airlines and energy have done well. All the small cap, look at the value space. Look at small cap value versus large cap growth. Are you kidding me? It's night and day. So I think this chart really shows that. And we anchored it specifically to that point so you can see the rotation since then, right? Because that's when everything changed, which I'll show you now in a second. By the way, if you're interested in these slides, go email info@allstarcharts.com and use the password value rotation. So make sure you use the password, because I give different presentations in different countries and you're bound to get who knows what presentation you'll get. So value rotation is the password for this slide deck if you're interested in the slides. When you tell me, JC, what's the monthly candle that stood out the most? See, I knew this one was coming, right? Because I've been watching this freaking index every day my entire career, because it's like, I don't know, maybe the most important index in the world, or got to be in the conversation. It's one of them, right? U.S. financials, like, yeah, it's pretty important, right? So I obviously watched it. So I knew when I'd pull this up, I mean, I could have drawn it for you, so it wasn't a surprise. There were some other charts that may have surprised me a little bit more, like freaking European banks on a relative basis. You want to talk about surprises? I didn't see that multi-year highs in that relative strength chart, but I mean, I guess that it just reiterates what we're seeing in this chart. The fact that freaking European banks are breaking out on a relative basis, financials coming out of a 14-year base. I mean, what do you want me to say? There's no way that I can go out of my way to be bearish equities as an asset class, and financials are breaking out of a 14-year base. So the bear case for equities needs to start right here, that this is like an epic failed breakout, like this like ridiculous whipsaw, and now financials are going to get slaughtered. Yeah, I guess you could, that's a theory, that's a thesis that you can have. Now, let's play that game. Let's say we do have that thesis, right? The world's coming to an end. This is the bubble, valuation, margin debt, Spanish bonds, whatever your freaking conspiracy theory of the day might be, that equities are going to crash. Let's play that game and say they are, right? Fine. So let's say, okay, we're bearish equities. Let's short everything. Okay, fine. So shorting financials, right? You'll probably want to short financials. If the world's coming to an end, U.S. financials are probably going to struggle. Probably a good spot to be shorting some stocks if that's the strategy that we want to deploy. Fine. How do we execute upon that? Well, if I'm bearish equities for whatever reason, and I want to be short financials from a risk management standpoint, I can't be short if we're above those former highs, right? There's no entry point yet. I'd be sitting here, talking about, okay, we want to short financials, and as soon as we break back below, that's confirming the whipsaw, and we're all in, right? That would be the trade. If you go back to October of 2018, very similar, failed breakouts. The risk was very well defined, short against that, fantastic. If you go back last year, actually, a lot of failed breakouts, very well-defined risk on shorts. Again, because these failed breakouts tend to be, commonplace. They show up at the beginning of downtrends. Like, go back forever. Go back to the 60s. You'll find at the beginning of severe sell-offs, you're going to see a lot of whipsaws in different important indexes and sectors and stocks around around the world, really. So this would be that. But in those other occasions, like October of 2018, like in January and February of last year, there were a lot of other signs suggesting that those were failed breakouts. From an intermarket perspective, from a breadth perspective, from a sector rotation standpoint, and relative weakness in certain important areas like transports and banks, like there was a lot of other information pointing to, no way, this breakout is bullshit. Like this thing's falling apart any minute now. We need to be short. That is not what's happening here. In fact, all the information is the opposite. It's suggesting financials should be breaking out, should be making all-time highs. And it just so happens that now is when it's now catching up, because it's got like crap like Wells Fargo in there and like just terrible stuff that has been dragging it down. So some of its cousins like capital markets, for example, have already been making new all-time highs. The broker dealers and exchanges have already been making new all-time highs. Even regional banks closed at an all-time monthly closing high, regional bank index. So, to me, I'm not seeing the evidence that suggests this is this massive whipsaw that we need to be shorting. I mean, I'm seeing the opposite, and which is great. We've been bullish Berkshire Hathaway, which is the largest component of the XLF. You mix in some industrials in there, sprinkle a little Dairy Queen. What I did there? Sprinkle some Dairy Queen. All right. So, and it's not just a U.S. thing. As I mentioned, the European banks here, we're looking at the global financials index relative to the FTSE All World Index without the U.S. to really show what's happening around the world. What are we seeing? We're seeing it breaking out on a relative basis around the world as well. So it's not just a U.S. thing. All right, fine. Let me get my mug out of the way here. So this is really important because this is what I was just talking about that changed in the beginning of September, right after Labor Day, is the growth versus value really started to change right here, right? You could see it right here. See it. That's where it started. And it's happening down the cap scale, right? So as these charts are going up, that's growth outperforming value, which we've had, right? As you're well aware, it hasn't been a secret. And, the financial advisor community is always asking me, is it growth versus value? Growth, is it changing? It's changing. And like, we've always really stuck to the trend, but that's changed. And over the last couple of weeks, as interest rates really spiked, it's become more pronounced, really confirming that change in trend instead of going from a sideways regime to value being in control. And this, again, down the cap scale, mega cap growth rolling over versus mega cap value. Same thing in the large cap space, and small cap growth rolling over, making new relative lows compared to small cap value. So it's happening down the cap scale. So what does that mean? Well, the best areas to be is like software, tech, discretionary, all these growth areas, and financials and energy have been the worst places ever for a long time. Well, guess what? Financials are breaking out. Energy stocks are breaking out. Those are value names. They're outperforming growth, right? So it makes sense. Here's a little cheat for you. Tech versus financials, as you can see here in green, looks exactly like growth versus value. And then the former sector leaders, right? Tech, communications, discretionary. So it's Facebook, Google, Amazon, Microsoft, Apple, right? Those are these. Versus industrials, energy, and financials on an equally weighted basis. So it's basically the former leaders versus the new leaders, right? The former laggards. And it looks just like that. That's growth versus value. So these are the names that have been winning. Industrials. Look at Caterpillar. Look at all like the base metals around the world, the countries that you're taking these base metals out from, the companies building the machines to take these things out of the ground, the energy names, oil making new highs, CRB index making new highs, XLF is the financials, banks breaking out, Berkshire new all-time highs. So this is really, I think, tells the whole story. Particularly when you combine it with the reopening rotation bubble chart that we showed, it just makes sense, right? The best names, regional banks, these are all value names over here versus the growth that's been a huge underperformer. So it's not really anything new. It's just become more pronounced. And this comes with rising rates. We'll get back to this one in a second. But as you can see here, here in the U.S. 10-year yield is now finally starting to catch up. Because copper versus gold has literally been ripping as copper has exploded higher and gold's been, nothing but a bummer, right? So the ratio of copper versus gold has been ripping, suggesting rates are going up. Regional banks, as we pointed out to, have been a huge outperformer. When they're outperforming, that again points to higher interest rates. As you can see here, these lines look exactly the same, right? By the way, here's that example of October of 2018 when rates got above 3%. Copper gold ratio is already rolling over. Regional banks already rolling over on a relative basis. So, they were saying that this was, this was horseshit. This wasn't for real. And then everything fell apart from there. But the other intermarket relationships were already pointing to lower rates, not higher rates. And then here it's been the opposite. As regional banks have outperformed and copper has shined over gold. See what I did there? Shined. It was suggesting rates should be going higher. And then sure enough, rates have absolutely exploded. So with rates exploding, that coincides with growth underperforming value, value being the leadership group. And it doesn't necessarily mean that stocks are going to sell off and there's this impending doom and, what the conspiracy theory guy that you follow, on the Twitter, what he's saying, like, or she, it's usually a he. I feel like there's fewer female perma-bears, which is a good thing. Kudos to the ladies out there. Listen, when I first got in this business, 18 years ago, 17 years ago, whatever it is, rates were going up. Tech was underperforming, right? Growth was the underperformer. Like the companies that we were buying were banks, Lehman Brothers, Merrill Lynch, Bear Stearns, right? Goldman Sachs eventually. I remember buying like Walter Industries and like Peabody Energy and like these massive like industrial stocks. Not the technology, right? It was just a different world. It was a world where rates were rising, and in a lower when the market thinks that the rates are going to go lower, you're going to get the opposite, which we've seen obviously as growth and all these things have outperformed. So, and by the way, the market did fantastic in 04, 05, 06. It didn't peak till October 2007. If you look at the S&P 500, so it did very well in this environment. So I don't think it's anything to be scared about. I think it's really bad for the passive investing community for sure. They're the biggest losers here, I think, because as they have been, this whole massive rotation out of growth and into value has destroyed the passive investor. I mean, we're talking 2,500 basis points, like monster dislocations between what these sectors are doing and what some of these areas are doing versus the indexes, which in many cases are so heavily weighted towards these massive growth names. So huge, the big losers, the passive investor. And I think that continues because something like an energy, where energy represents like 4% of the S&P 500, it could triple and it won't put a dent in the indexes. You know what I mean? So like, just think about that. And then look, another example here. Look at value versus momentum breaking out of this base, right? You see that? Right? As interest rates make new highs. So they all look together. I think it's really all part of the same story. So where are we wrong? I think we're wrong at 1.4%. That's the level. I mean, that's been my target for pretty obvious reasons. Like, you don't need to be like a CMT to know why, or maybe you do, I don't know. But to know why I was choosing 1.4, because those were the lows in 2012 and 2016, last year, like those were the lows, right? So when we broke, there's memory there. So, okay, the target, I mean, we nailed it, right? Fortunately. But now, okay, Einstein, now what do we do? It's like, I don't know. We got here, right? So now what? Well, I always, and people laugh at me, I feel like I'm the only person that looks at the US 5-year yield. But for me, it's a great leading indicator. I mean, it's just a fantastic leading indicator. Look at that 2012 low, and we just ran right through that. Like it wasn't even there. Like definitively so. So for me, what are we going to, what do you want me to say? Like we're above those former lows from 2012. You got to bet the 5 years going higher. And if you're going to bet the 5 years going higher and that the 5 years above those 2012 lows, if we look at the 5 years, a leading indicator, which I do, over the years, you sort of find these little cheat codes. Belgium, the Belgium 20. If you want to know what Europe's up to over there, go check out the Belgium 20. Is another good one. So I feel like I'm the only one that looks at the 5-year yield and the Belgium 20, but those are great ones. Anyway, look at those lows, and then we're back. So if the 5-year is going to be definitively above those 2012 lows, why can't the U.S. 10-year yield hold above that as well? And so far it has. It has. So where is this rotation, thesis wrong? I think the bond market is going to be a big indicator of that. And just think about overall, rates keep going up, money keeps coming out of bonds, which makes sense as high yield keeps outperforming treasuries, goes into stocks, makes perfect sense to me. And we'll continue to monitor that, see if there are any changes there. All right. So Dow Jones Industrial Average, Dow Jones Transportation Average for you Dow theory enthusiasts, new all-time highs. And then for, you people, what do you mean you people? So for you people who, don't think that the Dow Jones Transportation Average matters anymore, and you think that, U.S. services and goods are delivered through the internet, which they are, and those are the new transportation methods of today. This is what we like to call the new Dow theory 21st century. Transports, new all-time highs. Semiconductors, new all-time highs. S&P 500, new all-time highs. So anyway, the point is, old school Dow theory, new school Dow theory, no divergences, not seeing anything there. Another great cheat code, as far as I'm concerned, is consumer staples. If the stock market's going to go higher, or when the stock market's doing well, consumer staples underperform. But when stocks are under pressure, you'll see outperformance in consumer staples. That was one of the reasons why we're so bearish in January, late January, early February last year. And again, and also in 2018 for that matter, we're going to stick with that theme. There was outperformance out of staples suggesting something was up. What are we seeing? New multi-decade lows in staples on a relative basis. This chart, or this behavior, is consistent with an environment that stocks are doing well. And as it turns out, stocks are doing great. New all-time highs in semis and S&P and the Dow, the Dow transports, like everybody's making new highs. But what's not making new highs? The most defensive areas in the world. JC, what are the most defensive areas in the world? Where does money go the fastest when it is scared to death? When shit hits the fan, where's money going to go? Japanese yen, gold, U.S. Treasury bonds. They're all making new lows, and throwing the dollar in there too for fun, right? The dollar might not be making new lows, but it's hanging out near lows, right? Yen new lows, bonds new lows, 10-year note, new lows, right? So if there's real trouble out there, it's certainly not showing up in the defensive assets, which, it's just math, right? If money's going to leave someplace, it doesn't just disappear. It doesn't just evaporate. It goes somewhere else. Money is transferred, right? Is how it's the money flow that we're analyzing. And where's it going? To me, I'm seeing copper potentially breaking out of a 15-year base here. You see that? 15-year base for copper. And look at over the years, the CRB index looks just like it. By the way, there's a lot of oil in here, which is why it looks weaker than copper, or one of the reasons why anyway. Man, a copper breakout here out of this 15-year base, we've been talking about this super cycle in commodities. I think that's exactly what's happening here. I think that's exactly what this chart is pointing to. That's the stuff that I'm liking. Value, energy, financials. As long as we're above 1.4, rates higher, money keeps coming out of bonds. That's what I'm seeing. We like Chevron. We did a scan of value stocks. We have our growth stock scan, value stocks. Money's flowing into that area. So it's been easier to find stocks doing well in growth over the last how many years? A lot. I think it, based on the weight of the evidence, it's going to continue to pay to look for value names for sure. 96 is my level in Chevron. If we're above 96, I like it long. I think it heads up towards 123. You can take a peek at the value scan here. It's your usual metrics. I'm less concerned with the PE ratio and the or the price to book or whatever it is. I'm less concerned with that and more interested in the fact that they fall within this category. because you have that wind at your back if institutional money is flowing into these stocks. So I don't really care. Oh, the PE ratio is 8 or 12. I mean, whatever. I don't even know what a good PE ratio is these days. I guess my understanding is it's different for different sectors. It's all very confusing. It's all very subjective. It's not for me. I'm more interested in just that they fall within this category, right? That's how I look at that. And by the way, Oxy's another interesting one. If Oxy's above 24.5, I like this one long with a target near 38. Actually trades warrants for you junkies out there that need the beta. If you're looking for juice, this one trades warrants. Again, I wouldn't be long the warrants or Oxy if it's below 24.5. Way too much risk, especially in the warrants. But if we're above 24.5, it makes sense to me. I like it with a target up near 38. That makes a lot of sense to me. So if you are interested, again, in these slides, I'll send them all to you. Just email info@allstarcharts.com, password value rotation. All right, so we got a couple minutes. Take some questions. JC, doesn't a high VIX like this mean the market is volatile and stocks should fall in a volatile environment? I guess that, as the VIX, as the volatility index is trending higher, right, that tends to coincide with stocks falling and stocks under pressure. The VIX has sort of been, dribbling down, hanging out near 20, in the 20s. Let's see where we're at. We're in around 24. Still elevated, right? That floor ever since last year has been, that 20 level. That's been the floor. So not so much that an elevated VIX is bad for stocks. In fact, I would probably argue that the fact that it's so elevated and people are still paying such high prices for those insurance premiums, to me suggests that that's fuel to the fire. And so what I'm looking for, and I hate to be like Mr. VIX level guy, but like what I'm looking at is those levels, that 20 level. Like if we set a new floor lower in volatility, as opposed to the floor being 20, and we set a new floor down towards 12, think about what the stock market around the world is going to be doing in an environment that the VIX is sort of dribbling down. I'd argue stocks are probably doing pretty damn well, right? So that's how I look at that. And JC, this is from me. I'm asking myself, JC, where are you wrong? So this is JC asking himself. Let me go. So for me, I'm looking at these two indexes right here. Like I said before, when stocks, you go back to the worst bear markets ever, go back to not even that bad bear markets, just sort of sideways ranges. Just go back to environments you don't want to be owning stocks in however, go back as long as you want. And what you're going to find consistently is a lot of whipsaws, a lot of failed breakouts. From failed moves come fast moves in the opposite direction. You'll find them in the indexes and sectors and important stocks and not so important stocks also. So if the Dow or the New York Stock Exchange Composite likely together are below last year's highs, there's your whipsaw. There's your whipsaw. This is your alley-oop for the Bears, right? This is it right here. This is your alley-oop. This is like, Kobe throwing it up and Shaquille O'Neal ready to slam it down, right? That's what's going on. If this is the beginning of like some impending disaster, right? And I'd argue same thing with the ACWI. The All Country World Index with the U.S. obviously has been doing very well, especially compared to the one without the U.S. So if the ACWI without the U.S. is below last year, the 2018 highs, I would argue that is the same thing, right? So that's what we're looking for. That's where we're wrong. Those would be classic characteristics of environments where we don't want to be owning stocks. So again, if you're interested in the slides, info@allstarcharts.com, and they're off.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.